Imagine earning a 7% plus yield from a top Philippine bank with record profits, all while its stock price is beaten down. Metrobank just reported a 9-month 2025 net income of 37.3 billion pesos, yet the share trades around 60 to 70 pesos only. That gap suggests big upside and a locked-in high yield. With Metrobank's fundamentals strong, this could be a rare by the dip moment. Metropolitan Bank and Trust Company, or Metrobank, was founded in 1962 and has become a premier universal bank in the Philippines. It is consistently cited as one of the largest private banks in the country. In fact, Metrobank is the fourth largest universal bank in the Philippines, behind BDO, Land Bank, and BPI. The bank offers a full suite of services: retail and corporate lending, deposits, credit cards, and investment products, and has a vast branch and ATM network nationwide. This scale gives Metrobank broad reach across the Philippine economy. Bank stocks like Metrobank can be powerful investments for several reasons. First, they typically pay high, stable dividends thanks to their steady cash flows. A financial analysis notes, bank stocks offer the strongest dividends in the market with conservative capital levels and exposure to rising interest rates. Indeed, most banks hold substantial cash and deposits, earning steady interest spreads. As Investopedia explains, higher interest rates boost bank profitability by widening the gap between loan yields and deposit costs. In other words, when rates rise, as they have been, banks make more on each loan. This can translate into higher earnings and dividends. In addition, dividend-paying bank stocks are often defensive and reliable. Many banks operate under strict regulations, Basel III, and hold strong capital buffers, making their dividends relatively secure. Historical data show that dividend stocks tend to outperform over the long run while exhibiting lower volatility. By owning bank stocks, investors gain direct exposure to economic growth through loan demand and a floating rate business model that profits from inflation and rate hikes. Here are reasons why bank stocks can be great investments. High dividend income. Bank stocks usually pay out a large portion of profits as dividends, giving investors regular income. Metrobank itself has been generous with dividends. Rising rates advantage. With policy rates elevated, Metrobank can earn a higher net interest margin. Experts note that when interest rates are higher, banks make more money by taking advantage of the greater spread. The recent series of rate cuts by the Central Bank of the Philippines, 175 BPS off in 2025, may have eased loan demand now, but loan growth and lending margins have already been built up from the prior high-rate period. Consumer shift and loan growth. Even as corporate borrowing has softened, Philippine banks are pivoting to consumer, SME, and housing loans. Metrobank's strategy reflects this. Consumer loans jumped plus 15.8% year-on-year, helping sustain double-digit loan growth. Steady loan growth fuels interest income and asset expansion. Capital strength and stability. Major banks in the Philippines hold high capital ratios for safety. Metrobank's capital adequacy ratio, CAR, is around 17%, well above regulatory minimum, and its non-performing loan, NPL, ratio is very low, around 1.7%. These figures indicate robust balance sheet health, which underpins consistent dividends and lower investment risk. In short, banks are often cash-rich, high-yielding companies whose profits grow in line with the economy. Metrobank, in particular, combines these advantages: well-capitalized, dividend-paying, and leveraged to Philippine growth. Metrobank's latest results illustrate its strong performance. Record earnings. Q3 2025 net income was 12.43 billion pesos, up 2.6% year-on-year. This lifted 9-month income to a record 37.28 billion pesos, up 4.3% year-on-year. Loan growth. Gross loans grew 10.8% year-on-year to 1.9 trillion pesos by September 2025. Consumer loans rose around 15.8%, while corporate and institutional loans grew around 9.5%. This robust lending fueled higher interest earnings. Net interest income. Q3 net interest income jumped 14.5% year-on-year to 31.78 billion pesos. For the 9-month period, net interest income was 91.81 billion pesos, 7.1% year-on-year. In short, Metrobank earned more interest on loans as deposits rolled over at slightly higher rates, boosting its spread. Key profit margins. Despite increasing loan growth, Metrobank maintained healthy margins. Its net interest margin, AM, averaged around 3.7% in 9 months of 2025, down a hair from 3.9% last year, but still good in today's market. Cost controls helped too. Operating expenses in Q3 actually fell 5.8% year-on-year to 19.41 billion pesos, and the cost-to-income ratio improved to about 49.8% versus 52.2% a year ago. Lower costs plus higher margins means more of every peso of income falls to the bottom line. Asset quality and capital. Metrobank's non-performing loan ratio remains very low at around 1.7%, with an NPL coverage ratio of 147%. Its capital adequacy ratio is around 17%, well above the 10% requirement, and Tier 1 at around 16.3%. Return on equity stood at around 12.5%, showing solid profitability on its equity base. Overall, Metrobank's 2025 results show sustained loan growth and profitability, with tight cost control and excellent asset quality. These fundamentals are exactly what dividend investors love. Metrobank is extremely generous with payouts. In 2025, it declared a total dividend of 5 pesos per share, split as 3.5 pesos special dividend, paid in March, and 1.5 pesos regular dividend, paid in September. That's a very large payment. Divide 5 pesos by the stock price, and you get an eye-popping dividend yield. For example, at today's price range of around 70 pesos, the dividend yield is roughly 7.1%. Even using the 65 pesos average price, which gives 7.7% yield in October 2025, Metrobank's yield is unusually high. By comparison, BDO Unibank, the Philippines' largest bank, yields only about 3.4%. In fact, stock screener data shows Metrobank's yield at around 7.1% versus BDO's 3.6%. So at 70 pesos, yield equals 5 divided by 70, which equals to 7.1%. These figures are much higher than typical Philippine bank yields. A yield north of 7% is rare for a blue-chip bank. It means you can get around 7,100 per year for every 100,000 pesos invested. In effect, Metrobank is paying you to own its stock, but only if you buy at these depressed levels. Let's see what those yields mean in real money. 100,000 pesos invested yields around 7,000 pesos per year, around 583 pesos per month at a 7% dividend yield. 500,000 pesos invested yields 35,000 pesos per year, around 2,917 per month. 1 million pesos invested yields 70,000 per year, 5,833 pesos per month. That's purely passive cash just from dividends, on top of any stock price gains. As Investopedia notes, dividend-paying stocks give steady income and often outperform over time. The math shows even modest investments in Metrobank today can generate significant monthly cash flows if the dividends hold up. Despite these strengths, Metrobank's share price is down roughly 15% in the past year. In fact, Simply Wall Street rates Metrobank as about 15% undervalued based on its fair value models. Why has this happened? Several factors have weighed on Philippine bank stocks. Weak market sentiment. The Philippine stock market has been the world's worst performer in 2025, dragged down by economic concerns. Domestic issues. Notably, a high-profile graft scandal and worries about future infrastructure spending have shaken investor confidence. When general sentiment is weak, even strong companies can see their prices fall. Policy rate cuts. The central bank unexpectedly cut rates 5 times in 2025, totaling around 175 bps, bringing the policy rate to a multi-year low of 4.75%. While lower rates aim to spur growth, they also squeeze bank net interest margins, since loan rates fall faster than deposit rates. Analysts warn that lower rates put pressure on banks' margins. The market may be marking down bank valuations in anticipation of slower profit growth from margin compression. Rotation to consumer lending. Metrobank and peers are shifting away from high-margin corporate loans to more retail and SME lending. While this increases loan volumes, retail loans often carry lower spreads. Investors might fear that sustained margin pressure could hamper earnings. Profit-taking. After years of share price gains, some investors simply took profits, causing a pullback. Additionally, foreign selling in Philippine banks has been notable in 2025 as global portfolios were repositioned. However, it's worth noting the gloom may be overdone. Metrobank's fundamentals, record profits, solid loan growth, and low loan defaults are intact, and high dividend payouts are guaranteed per share at whatever price you pay. As Investopedia advises, downturns offer the chance to buy low on companies with strong fundamentals. Peso cost averaging is also wise if you can accumulate shares gradually as prices dip. In short, while macro uncertainty lingers, the pullback in Metrobank's price has pushed its dividend yield to an exceptional level. Each day you delay buying, you lock in a lower yield on future dividends. As the saying goes, you don't earn yields on paper gains. Buying today's low price locks in the 7 to 8% yield on all future payouts. Reasons to buy Metrobank. Very high dividend yield. At current levels, Metrobank yields well over 7%, roughly double its peers. This income alone makes the investment attractive. You're getting cash back at a rate usually only found in very risky stocks. A high yield also provides a cushion. If the stock price rises 7 to 8% in a year, you've effectively made 15% total return, stock gain plus dividend. Strong recent profits. Metrobank's earnings are robust. 9-month net income hit a record 37.3 billion pesos, up 4.3% year-on-year, even before Q4. With Q3 net income already up 2.6% year-on-year. Analysts expect full-year 2025 profit to be the best ever for Metrobank. Buying now means capturing those profits at today's low price. Loan growth and net interest income momentum. Loans are growing double digits, and net interest income is up 14.5% in Q3 2025, reflecting strong core business momentum. If the economy recovers or even stabilizes, this lending growth should continue, driving future earnings higher. Undervalued on fundamentals. As noted, MBT appears undervalued. Simply Wall Street estimates the stock is around 20% below fair value. If macro fears ease or the market re-rates banks higher, Metrobank could gap up. Even a recovery to fair value would boost the stock by around 15 to 20%. Economic growth story. Long-term, the Philippines economy is projected to grow around 5 to 6% per year. Big banks like Metrobank typically benefit from GDP growth through higher lending and transaction volumes. Buying now allows investors to lock in a stake in this growth. Reasons to hold Metrobank. Rising passive income. Every year you hold Metrobank, you get paid dividends, expected 5 pesos per share in 2025. Reinvesting these dividends can significantly compound wealth. Metrobank's track record suggests it will likely continue paying hefty dividends as long as earnings remain strong. Established franchise and growing market share. Metrobank has a solid consumer base and growing middle-class market to lend into. Its pivot to retail lending should yield more stable, recurring interest income over time. Holding through cycles will let you ride out any short-term volatility and benefit from eventual economic recovery. Strong capital base. The bank's high capital ratios act as a buffer. As a long-term holder, you can be confident that Metrobank meets regulations and can absorb shocks, which means your dividends have a high degree of safety. Strategic undervaluation. Long-term investors know that buying low locks in future upside. If Metrobank's price stays low, its yield stays high. Historically, Philippine bank stocks have rebounded strongly after periods of panic. Staying invested or adding on dips could pay off as sentiment turns. Inflation hedge. Banks can act as partial hedges against inflation, since they lend at variable rates. If inflation stays above 5%, Metrobank's net interest margins may slowly tick up, banks eventually repricing loans. Holding Metrobank positions you for that inflationary tailwind. Reasons to sell Metrobank. Need for liquidity or lower risk tolerance. If you suddenly need the cash or cannot tolerate further short-term losses, it's reasonable to sell. Remember the adage, only invest what you can afford to lose. Investopedia warns to assess your finances before buying dips. If personal circumstances change, a partial sale can lock in gains. You still keep dividends on remaining shares. Deteriorating fundamentals. Watch for warning signs. If Metrobank's loan quality worsens, or if it cuts its dividend drastically, that would break the thesis. For example, if BSB continues cutting rates aggressively and margins shrink beyond expectations, profitability could suffer. In such a case, exiting or reducing exposure may be prudent. Better opportunities. If you find an investment with higher risk-adjusted return, consider rotating. Bank stocks are not the only high-yield game in town. The opportunity cost of holding any stock should always be evaluated. However, keep in mind the difficulty of timing. Don't sell Metrobank just to leap into something less certain. Tax or portfolio rebalancing needs. Sometimes investors sell for non-market reasons, rebalancing or tax strategies. If Metrobank has become an outsized portion of your portfolio, trimming to rebalance can make sense. Just do so gradually. Dumping all shares in a panic sell-off is discouraged. Tip 1. Stick to your plan. Stay disciplined. Buying depressed stocks feels scary, but data-driven investors stay calm. Experts note that timing the bottom perfectly is almost impossible. Instead of panic selling or market timing, focus on fundamentals and buy the dip gradually. Tip 2. Only risk what you can handle. Don't bet the farm. Ensure you have an emergency fund and minimal high-interest debt before piling into stocks. Only invest money you won't need for several years. This way, short-term volatility won't force you to sell at a loss. Tip 3. Peso cost average. Rather than investing a lump sum all at once, consider buying in tranches, monthly or quarterly. This peso cost averaging approach automatically buys more shares if prices dip, lowering your average entry price. It removes the emotional pressure of waiting for a bottom. Tip 4. Focus on value, not noise. Tune out short-term market noise. Remind yourself of Metrobank's long-term story, rising dividends, growing loan book, and a recovering Philippine economy. If your investment thesis remains intact, little news should force you to sell. Meta tip: follow company disclosures and trusted sources, not social media panic. Tip 5. Reinvest dividends. To turbocharge wealth, consider automatically reinvesting Metrobank dividends into more shares. Reinvestment lets compounding work in your favor as you earn dividends on previous dividends. You can simply buy before ex-dividend dates. Metrobank today is one of the rare moments in the stock market where price, fundamentals, and dividend yield all line up perfectly. We have a stable, conservative, well-capitalized bank, trading at a discount, while delivering one of the highest and most consistent dividend payouts in the Philippines. Opportunities like this don't stay open forever. When prices are low, your future passive income becomes higher. When everyone else is afraid, steady investors quietly build their positions. And when the market finally recovers, those who moved early become the ones who benefit the most. So if you believe in long-term investing, if you want reliable dividends, and if you want to take advantage of this dip before the window closes, Metrobank is the kind of stock that rewards patience and conviction. If you found this useful, please hit the like button and subscribe to Thrifty Finance Vision PH so we can make more videos like this.